Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, The Crime Scene Economy. Incentives, Attention, and the Disappearance of Nancy Guthrie. There's a line in this story that hits like a cold coin on a table. Blood linked to Nancy Guthrie was found on the porch, and gloves were recovered by investigators. That's not atmosphere. That's not a mystery. That's a business-like fact pattern. A physical world balance sheet entry. And once you have that, your brain should stop doing what it loves to do, telling itself comforting stories, and start doing what it hates to do, running the incentives forward, tracing second-order effects, asking what's real, what's performative, and what people do when the cameras arrive. Because this isn't just about a missing person. It's about what happens when a private crisis gets pulled into the public markets of attention. The moment this became the disappearance of the mother of a national television anchor, it stopped being only an investigation. It became an ecosystem. Operators, constraints, resource allocation, reputation management, and the one thing that makes everything harder, the constant temptation to mistake motion for progress. Let me back up and set the scene, exactly as the article lays it out, and then I want to think out loud about the machinery underneath it. Not the gossip, not the theatrics. The machinery, the incentives, the choices, the compounding consequences. This story is from the Wall Street Journal, and it opens in a way that feels eerily modern. Drones buzzing over a normally serene neighborhood. Picture it, Catalina foothills, Arizona. Tall saguaros, 30 feet, standing like silent witnesses. Dozens of cars parked along the street. Trunks open, camera equipment visible. TV anchors converging. A residential street turned into a temporary headquarters for competing institutions. Law enforcement, federal agencies, and the media. And somewhere inside that pressure cooker is the central fact. Nancy Guthrie, 84 years old, health issues, reliant on daily medication, disappeared. Now, the central figure most people will name is Savannah Guthrie, Today Show co-anchor, public face, but in my mind, the central figure in a story like this isn't the celebrity, it's the decision-maker. And Savannah becomes a decision-maker here, whether she wants to or not, because she becomes the operator of the family's public interface with the world. That's a brutal role. In business, we talk about the founder as builder and allocator. Here, she's not building a company, she's building a narrative boundary. She's allocating attention. She's deciding what to say, when to say it, how to respond to messages, how to treat claims like ransom demands in a world where voices and images can be manipulated. That's the modern constraint. Reality is expensive, and fakes are cheap. So what actually happened according to the article? Let's walk through it cleanly. Nancy Guthrie took an Uber to her daughter Annie's house, had dinner and games, and later that night she was dropped off at her home in a Tucson suburb. The time matters because timelines are the first ledger in an investigation. The garage door opened and closed. Then, hours later, there's a figure outside. The article describes a person wearing a ski mask passing under the brick arc outside her front door, approaching the Nest camera, raising a gloved hand to block the lens, and then grabbing what appeared to be a handful of brush to further block the camera. That detail, brush, tells you something important. It's not just concealment, it's someone thinking, improvising, taking the environment and turning it into a tool. That's not random. That's intent. Then another hard timestamp. At 2:28 a.m., her pacemaker app showed a disconnect from her phone. I want you to feel how stark that is. A modern heartbeat, digitally tethered, and then the tether breaks. In investing, we love metrics because they're clean. In life, metrics show you the exact moment the world changed, without telling you why. Later that morning, she didn't show up for a virtual church service at a friend's home. Her daughter Annie and son-in-law went to check on her shortly before noon, and the family called to report her missing. The sheriff, Chris Nanos, says search and rescue dogs and volunteers were activated. And early on, he said something that matters. Authorities believed they had a crime scene, that they had a crime, and that this wasn't somebody who just wandered off. That sentence is a strategic declaration. It's law enforcement telling the public and the family, stop hoping this is benign. Stop assuming this is an accident. We're operating under a different model now. Then federal involvement deepens. The FBI provides analytical and technical help, downloading and analyzing cell phones, obtaining cell tower information, conducting interviews, investigative support. And still, few answers. That's the part people struggle to accept. We live in a world where we assume capability implies outcome. Like because the FBI shows up, the problem should shrink quickly. That's not how hard problems work. Capability increases the probability of progress, not the guarantee of it. Now the story introduces what feels like an inflection point, a moment that should have broken the case open. Video footage shows a person outside her home the morning she disappeared. Authorities detained a person for questioning, and the FBI director, Kash Patel, trumpeted substantial progress. Then the next day, the detained person is released. Searches yield no breakthroughs beyond items found, including gloves. This is the whiplash. And whiplash is dangerous because it creates a vacuum, and vacuums get filled by speculation, by opportunists, by performative certainty, by people with nothing at stake offering confident theories. The article mentions just how big the information inflow became. Nearly 18,000 calls received since February 1st. That's a staggering number, and it creates its own operational problem. Every call is a potential lead and a potential sinkhole. Attention is finite. Analyst hours are finite. The very popularity of the case becomes a tax on the investigation. And that brings us to the capital allocation angle. Because yes, even here, capital allocation exists. It's time, it's manpower, it's focus. It's what gets investigated first. It's what gets said publicly. Let's talk about the family's decision-making, because it's the most human and the most strategic. Savannah steps away from her morning TV role and becomes a public spokeswoman for her mother's return. She posts an Instagram plea with her brother and sister, and she says something that, if you've ever negotiated anything high stakes, you recognize as disciplined. She addresses reports of a ransom letter and says they're ready to talk, but they need to know without a doubt that she is alive and that you have her, because voices and images are easily manipulated. That is not a throwaway line. That is an operator describing the risk of counterfeit proof of life in a world where manipulation is cheap. It's the family trying to avoid paying for a story instead of paying for a person. Then there's another turn. The head of the FBI's Phoenix office, Hyth Yanke, says a ransom note distributed to the media made a demand for 5 p.m. that day, and he thought a second demand was for the following Monday. He says, any action regarding a ransom would be up to the family, warns of opportunists, and says law enforcement made an arrest over an imposter ransom demand. That's the crime scene economy in action. The moment a case becomes high profile, it attracts parasites. Not metaphorically, literally. People trying to monetize fear. And then, days later, the sheriff's department says they were inspecting information in a new message regarding Nancy Guthrie. Savannah posts another video saying they received the message and they understand, begging for her return, and then says something that's almost impossible to say out loud unless you mean it. This is very valuable to us, and we will pay. Not in a cynical way, in a serious way. What was expected when the family went public? Probably this. Increase pressure on the perpetrator. Increase the odds that someone recognizes something. Increase public vigilance. Keep the story alive so it can't be quietly abandoned. What actually happened? The story gets massive attention. The neighborhood turns into a media zone. Law enforcement resources deepen. But the investigation still yields few answers publicly. And the family now has to manage not only grief and fear, but also the risk of manipulation, false leads, imposters, and the relentless appetite of the public for updates. Opportunity cost? Privacy. Psychological bandwidth. The ability to grieve quietly. And here's the hidden trade-off most people miss. Once you step into a public negotiation posture, we will pay. You may create new incentives for opportunists, even as you try to reach the real party. Again, I'm not judging the family, I'm saying this is what incentives do. You can be morally correct and still face mechanical consequences. Now we have to address the visuals, because the instructions here matter. You said the podcast video will show the text on screen like Founders, and if there's a picture or a graphic, it will be shown too. So I'm going to narrate those visuals as if we're watching them together, aligned with the evidence. On screen, you see investigators searching the edges of Nancy Guthrie Street in the Catalina foothills. I want you to picture the landscape. The desert suburb aesthetic, the tall saguaros, the sense of open space that somehow makes a disappearance feel even more impossible. Where could someone go without being seen? You can feel the scale problem. Too much terrain, too few definitive signals. On screen, you see Pima County Sheriff Chris Nanos at a news conference. He's not a character here, he's a constraint. The public wants certainty. He can't give it. The cameras want updates. He has to protect the integrity of the investigation. His earlier framing, crime scene, crime, not a wandering off, anchors expectations, and that anchoring itself becomes a commitment the department has to live up to. On screen, you see Savannah Guthrie with her mother in an NBC handout image. This image does something subtle. It converts an abstract missing person headline into a relationship. It makes the loss legible. It also increases attention, which increases both help and harm. Attention is a double-edged asset. It can compound in the direction you want, or it can compound into noise. Now, I want to hit the reality check section, because this is where value investors should feel at home. Reality checks are what we do. We strip away reputation. We separate story from cash flow. Here we separate story from signal. What are the signals? 1. The physical evidence the article mentions. Blood linked to her on the porch. Gloves recovered. That's not vibe. That's tangible. 2. The intentional camera obstruction. Gloved hand. Brush. That suggests planning or at least purposeful concealment. 3. The pacemaker app disconnect at 2:28 a.m. That's a timestamp that correlates with a disruption event, even if we don't know its nature. 4. Massive inbound tips. 18,000 calls. High interest, high noise. 5. The detained person released after substantial progress messaging. That's a sign that early confidence can be cheap, and reversals are expensive. And what's the uncomfortable truth? The uncomfortable truth is that public intensity doesn't guarantee investigative clarity. It can even reduce it. A case can be famous and still be opaque. In the modern environment, deepfakes, manipulated voices, viral misinformation makes negotiation and verification harder than it used to be. Another uncomfortable truth: the public's desperation for breadcrumbs can turn every scrap into a narrative, which creates pressure on institutions to do something, say something, show something. And pressure changes incentives. It pushes toward visibility over efficacy. It pushes toward confidence over accuracy. Now the lessons. I want 3 timeless, and I want them grounded in what we just walked through. Lesson 1. Incentives shape outcomes, even in tragedy. When a case becomes high profile, it attracts additional resources and additional predators at the same time. The same attention that can save someone can also fund opportunists, flood tip lines, and distort priorities. Lesson 2. Scale can become a disadvantage. 18,000 calls sounds like help, but it's also a processing burden. In investing, too much deal flow can make you sloppy. In investigations, too much inbound information can bury the signal. Scale without filtration is fragility. Lesson 3. Success carried too far creates failure modes. The success in this context is the ability to go public instantly, mobilize national attention, and amplify pleas. But if you push that tool too far, if every update becomes content, if every lead becomes a headline, you risk creating a market where bad actors show up, because the market is paying. The tool that helps also invites the threat. And now we end with conviction, because that's what you asked for. Not hedging, not media voice, but a serious thinker answering the core question the article raises. The core question is simple and brutal. In a case like this, does the machinery of modern attention help you find the truth faster, or does it make truth harder to reach? The answer is, it does both. It injects resources, urgency, and public eyes. And it also injects noise, predators, and pressure that can warp decisions. The job of the operators, the family, law enforcement, federal agencies, is to keep reallocating towards signal, away from spectacle, and to remember that the public narrative is not the same thing as the underlying reality. Because in the end, there is only one compounding that matters here. The compounding of time without answers is the most expensive curve of all. Moving to next title, The Slow Bull Doctrine, Beijing's National Team, AI Mania, and the Hidden Cost of Stability. A market that's allowed to feel too much becomes a political problem. And in this Wall Street Journal story, you can almost hear the logic clicking into place. When Chinese stocks run hot, a state-linked national team steps in, not to cheerlead the rally, but to cool it down. That one idea matters because it's the inversion of how most investors are trained to think. We're taught to ask, is the company good? Is the price right? Is the cycle turning? But here the real question is different. It's who is the marginal buyer and the marginal seller, And what are they optimizing for? And that's a repeating pattern, not a one-off. Every system eventually reveals its true objective function. In the US, it's often some messy blend of profits, incentives, and market share. In China, as this article makes plain, the objective function includes something extra: stability, social stability, political stability, financial stability. The kind that doesn't show up in a P/E ratio but shows up everywhere else. So let's name the central figure properly. Not a CEO, not a founder in the Silicon Valley sense. The central figure here is an operator, a capital allocator with essentially infinite patience and a different time horizon than you and me. It's the group market players called the national team. There's no official list, the article says, but the core includes Central Huijin Investment, a unit of China's sovereign wealth fund. And the article gives you the key advantage. This is the unfair edge that matters. Vast stock holdings, plenty of cash, and the ability to get liquidity support from the People's Bank of China. That combination makes the national team three things at once. A builder, because it helps build a stockholding culture and a functioning equity financing channel for companies. An allocator, because it expresses preference through flows, buying index funds when the market is sick, selling when the market is euphoric. And a constraint, because it places a ceiling on how irrational things are allowed to get before someone with size and intent leans against the tape. Now, what worked for a long time? The article points out that this national team has been a fixture for more than a decade, usually buying exchange-traded funds, and it was widely noted when it intervened during the 2015 crash to prop up prices. Then again, after President Trump announced his Liberation Day tariffs in April 2025 and global stocks sold off, the national team stepped in as a buyer of index funds to relieve the pain. That's the put. That's the backstop. But what quietly stopped working, and this is where the whole story turns, is the assumption that the backstop only goes one way. The national team doesn't just catch falling knives, it also takes some of the knife away when the room starts waving it around. That's the inflection point. Chinese stocks have been on what the article calls a serious bull run. The CSI 300 benchmark tracking shares, listed in Shanghai and Shenzhen, has risen more than 20% over the past year, despite an April dip. And the performance isn't just good for China, it's better than the US in the same window. The S&P 500 rose 14% in that period. The article says, now you can feel the psychology building. Outperformance creates stories. Stories create flows. Flows create higher prices create more stories. That's how bubbles begin, not with lies, but with truths taken too far. The article attributes the rise to enthusiasm about AI breakthroughs in China, and to a truce in the trade war between the US and China. And then it gives you the detail that should make any value investor sit up straighter. A handful of AI-connected companies, semiconductors, data center equipment, now have market capitalizations in the tens of billions of dollars despite relatively modest profits or none at all. That's the classic setup. A real technological shift, a real narrative, a real opportunity. And then valuation that starts pricing not just the future, but a perfect future, pulled forward, leveraged, and treated as inevitable. Here's where Beijing's preference shows up in plain language. The government, the article says, prefers what analysts call a slow bull market. And it even quotes the China Securities Regulatory Commission chairman Wu Qing. We must resolutely prevent drastic market fluctuations and actively guide long-term and rational investment. That's not investor relations talk. That's governance talk. That's an attempt to engineer the emotional profile of a nation's savings. And now we get into the decision autopsy, the capital allocation logic. If you're Beijing, what was expected from fostering a rising stock market? You want companies to raise money from private sector investors and become less reliant on bank loans. You want a stockholding culture that helps households build assets for retirement. And you want to shift the asset mix away from property. Because the article states the property market has been in crisis for years. The numbers here matter. Stocks are only 11% of total assets held by households in China, versus 32% in the US according to the article. Most Chinese household assets are in property, so the expected outcome is a rebalancing. More equity ownership, more market financing, less dependence on property and banks. But what actually happened, or what officials fear happening, is the part you can't ignore. They worry a frenzied rush towards stock investing would produce burst bubbles, big losses, and instability. And the immediate victims would be individual investors, who account for 60% of daily trading, the article says. That 60% number is the tell. It's the structural fragility. If the marginal price is set by individuals, sentiment can swing faster than fundamentals. And when sentiment swings in a society where household balance sheets are already concentrated in a troubled property market, the drawdown isn't just financial, it's political. So the government tries to do something that sounds impossible until you realize they have tools most markets don't. Stimulate the market while also stabilizing it when necessary. That's where the national team comes in as allocator. The article cites Goldman Sachs. As of the third quarter of 2025, the group had about 6 trillion yuan, roughly $870 billion, in exposure to Chinese equities, and that's about 6% of the market capitalization of China A shares. Read that again in your head, slowly. 6% of market cap, held by a state-linked stabilization complex that can buy, sell, and access liquidity support. Now you understand why some investors don't want to play. The article quotes Rui Suarez at FAM Frankfurt Asset Management saying they would consider investing in China, but given government interference, the answer is no. That's not moralizing. That's risk management. If your model assumes price discovery, and you're operating in a system where a policy objective can override short-term discovery, your edge can evaporate. But the article also gives you the counterpoint, and it's important. Xin Wu, founder of Banyan Partners, disagrees. He focuses on picking individual stocks that can beat the market, and doesn't mind if the national team is buying or selling ETFs tracking broad indexes. And he asks the question that reveals the emotional truth of all investors everywhere. What market wouldn't like a slow bull run? Of course, everyone wants compounding without pain. Now, here's the moment where the national team flips from hero to disciplinarian. The article says that according to Goldman Sachs, domestic China-focused ETFs had outflows of nearly $110 billion in the second half of January, suggesting selling by the national team. Morgan Stanley analysts interpret it as substantial, yet well-paced, selling that curbs but doesn't kill positive momentum. This is the slow bull doctrine in action. Don't pop the balloon. Bleed the air. Keep the room calm. Now let's do the visuals, because the visuals in this piece are not decoration, they're the evidence trail. On screen you see a performance chart labeled CSI 300 Index and China versus S&P 500 and US showing performance over the past year with an as of June 2025 note and sources fact set mentioned. You can see the CSI 300 line rising more than 20% over the year with a visible dip around April, and you can see the S&P 500 up 14% over the same period. The point of the chart isn't nationalism, it's narrative fuel. Relative performance becomes the story that pulls in the marginal buyer. On screen, you see another chart labeled something like Goldman Sachs Assets with categories: China, Japan, US, and a breakdown of household assets as a percentage of total: property, cash deposits, equities, mutual funds. You can see the visual imbalance. China's household assets dominated by property, with equities a smaller slice, and the article's key number, stocks at 11% in China versus 32% in the US, now feels obvious because you can literally see it. This chart is the why behind the policy. If your households are overexposed to property and property is in crisis, you need an alternative savings engine, but you can't let that alternative engine explode. And here's what most people miss when they look at those charts. They think it's about market returns. It's not. It's about social engineering through asset allocation. It's about moving a nation's savings from one bucket to another without triggering panic, backlash, or the kind of drawdown that teaches people to hate equities for a generation. Now the reality check. If you're a value investor, you should be allergic to two things: permanently high growth assumptions and undisclosed control. This story has both pressures sitting in the same room. On one side, you have AI-linked companies with tens of billions in market cap and modest profits or none. That's valuation risk. On the other side, you have a stabilization complex with 6 trillion yuan of exposure and the ability to lean on ETFs to guide the tape. That's governance risk. The perception lag is this: people see a bull market and assume it means confidence in fundamentals. But the article makes clear that part of what you're seeing is being actively managed, stimulated in drawdowns, restrained in euphoria. Price is carrying policy in its bloodstream. So what are the lessons? Timeless, portable, usable. Lesson 1. The marginal actor matters more than the average actor. When a national team can be the buyer in crisis and the seller in mania, your model of the market has to include that actor's objective function, not just earnings and multiples. Lesson 2. A country's household balance sheet is destiny. When most household assets are in property and that property market is in crisis, the push toward equities is not optional. It's strategic. But moving savings at scale requires trust, and trust is fragile. Lesson 3. Success plants the seeds of failure when it invites participation at the wrong price. A slow bull run is a beautiful thing, until it convinces individuals, who make up 60% of daily trading, that risk has been abolished. That's when compounding flips into ruin. Now the ending, and I want to answer the core question this article raises. The core question is, can you build a stockholding culture and a durable equity financing system without also importing the social volatility that comes with freewheeling bubbles and brutal crashes? Beijing's answer, at least as described here, is that you try. You use the national team as a stabilizer. You let the market rise, but you don't let it sprint. You absorb shocks on the way down, and you shave euphoria on the way up. You aim for a slow bull run because it's politically and socially compounding friendly. And here's the sentence I want you to remember for years. Stability isn't free. You just decide whether you pay for it in volatility today or in distorted price signals that compound quietly over time. The article starts by pointing out something that sounds like a throwaway line, but it's actually the skeleton key. For as long as index funds have existed, they've been under attack from competitors flinging one flimsy pretext after another. In the 1970s and 1980s, the insult was that index funds were settling for average. Then index funds went on to outperform the average active fund. In the 1990s, brokers called index funds tax bombs, supposedly threatening huge unexpected tax bills. That didn't materialize the way the scare story implied. Then came, index funds can't protect you from crashes. Neither could almost any active funds, it turned out. And now, the newest monster under the bed: concentration risk. I want you to notice what's happening. The specific claim keeps changing, but the emotional payload stays the same. It's always, this simple thing you're doing is secretly dangerous, and the solution is to hire me. That's not investing. That's customer acquisition. Now let's get concrete, because this piece is packed with numbers and comparisons that matter. The phrase Magnificent Seven gets thrown around like they're this unstoppable force that's breaking the index. But the article says most of the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, didn't even outperform the S&P 500 in 2025, and so far this year they are all trailing the index. Yet the fear campaign continues. Why? Because it feels like common sense. Eggs, baskets, the kindergarten version of risk. And that's exactly why it works. The best sales stories are the ones you don't feel the need to verify. Here's the inflection point in the article. It introduces research by Mark Kritzman of Wyndham Capital Management and David Turkington of State Street Associates. Their conclusion is blunt. If you own an S&P 500 or total stock market index fund, and you're thinking about diversifying out of it to reduce concentration risk, don't. And the reason is the part most people refuse to internalize because it's psychologically painful. Concentration goes up whenever winning stocks keep winning. In other words, the market becomes concentrated because the market is working, because capital is flowing toward the companies that are compounding value faster than the rest. So what happens if you take risk off the table every time the market gets more concentrated? Kritzman's line in the article is the one that should haunt anyone who has ever tried to get cute with allocation. It may help you avoid some fraction of sell-offs, but you incur a huge opportunity cost in losing out on the run-ups. Opportunity cost is the invisible line item that destroys returns while letting you feel intelligent. It's the tax you pay for emotional comfort. And then the article quantifies it historically, which I love because now we're out of feelings and into math. Over the past 90 years, the research says, if you cut back on stocks whenever the market was becoming more concentrated and added when concentration was declining, you would have earned an annualized average of 0.9 percentage point less than if you'd simply bought and held. 0.9 percentage point, annualized, over decades. That sounds small until you understand compounding. That's the difference between comfortable retirement and I can't stop working. That's the difference between optionality and fragility. Now I want to do the capital allocation autopsy the way we do it in business. Decision by decision, expectation versus reality, hidden trade-offs. Decision 1. I'll diversify away from the index because it's too concentrated. What was expected? Lower risk, less exposure to a handful of mega-cap names, a smoother ride. What actually happens historically per the article's research framing? You lose part of the run-up when winners keep winning. You might dodge some drawdowns, but you pay a bigger bill in missed compounding. Hidden trade-off. You shift from owning the market's evolving leaders to owning what the market is actively moving away from. And you do it at exactly the wrong time, when leadership is strongest. Decision 2. I'll hire an active manager to protect me from the concentration monster. What was expected? Professional selection, tactical moves, downside protection. What actually happened in prior cycles as the article recounts? The industry has repeatedly used scary narratives that didn't deliver superior outcomes after fees for most investors. Hidden trade-off. You replace a transparent, low-fee system with a higher-fee system whose main edge is storytelling. And the article gives you the line that explains the whole business model in one breath. Tim Atwill, former senior analyst at Russell Investments and ex-head of investment strategy at Parametric, says active managers are very good narrative creators, and the industry has had a lot of time to practice these narratives to make people believe managers possess magic. Don't fall for it. Now we get to visuals, because the piece includes a very specific on-screen data block that you're going to show in the video, and the narration has to match what the viewer is seeing. On screen, you see a table or list labeled with Total Return, 2025 inches, and Source Fact Set. Next to that, you see the names Amazon, Apple, Tesla, Meta, Microsoft, S&P 500, NVIDIA, Alphabet. And you see numbers in descending order: 66.0, 38.9, 17.9, 15.6, 13.1, 11.4, 9.0, 5.2. I want you to picture what that does to your brain. It invites a simplistic conclusion, some huge winners, some laggards, and it tempts you to treat last year's leaderboard like a permanent ranking. But that's not why it's here. It's here to puncture the myth that the big tech names automatically dominated the index that year. The S&P 500's total return number, 11.4, sits right there among them, and several of those giant names are below it. That visual is evidence against the lazy narrative. Then the article runs a thought experiment that's basically a Steelman argument against today's fear campaign. It says, if you had a time machine, you'd go to June 1st, 1932, when the S&P 500 had fallen 86.2% from its 1929 peak, because the subsequent long-term returns were extraordinary, roughly 12.3%, 15.1%, and 16.1% annualized over the next 10, 20, and 25 years. And then it makes the compounding vivid. A 16.1% annualized return over 25 years turns 100,000 into nearly 4.2 million. Here's the punchline that flips the whole conversation. On that date, 12.7% of the value of the entire U.S. stock market was a single company, AT&T. That's higher than today's biggest stock, NVIDIA, which the article says is 7.8% of the S&P 500 and 6.9% of the total U.S. market. So, the concentration monster wasn't a monster then. It was the entry point to some of the best long-term returns in history. Now, let's do the reality check, because this is where investors either grow up or get sold. The article makes a subtle but crucial point. Diversification isn't only about how many companies you own or how much you have in each. It's about economic exposures, suppliers, technology, products, markets, access to capital, geographic reach. Giant companies, even in the same industry, can have far more diversified exposures than small companies. That's why the research finds investing in only a handful of the biggest companies has essentially the same riskiness as owning all the rest of the stocks in the S&P 500 combined. Most people hear that and think it's a trick. It's not a trick. It's just that the intuitive definition of diversification is incomplete. Perception lags reality because 7 stocks sounds like a tightrope, but economic exposures spanning the planet is a very different thing. The label fools you. The underlying exposures matter. Now, 3 lessons. Timeless and brutally useful. Lesson 1. In investing, fear is often a marketing channel. When someone tells you the market is broken and only they can navigate it, your first question should be, are they selling insight or are they selling a subscription to anxiety? Lesson 2. The cost of being wrong isn't only losing money, it's missing compounding. The article's 0.9 percentage point annualized shortfall over 90 years is the kind of quiet penalty that wrecks lives without ever making headlines. Lesson 3. Diversification is a property of cash flows and exposures, not just a count of tickers. If you can't explain what your holdings actually depend on to earn money, you're diversifying by superstition, not by design. And now I want to end with conviction. And I want to answer the core question the article is really asking. Is a technology-heavy, mega-cap-dominated market inherently dangerous for index investors? This piece says no, at least not for the reasons being sold to you. The danger isn't that the market is concentrated. The danger is that you let a scary story talk you into bad capital allocation. Here's the sentence to remember for years. The most expensive mistake in investing is selling the compounding machine because someone sold you a bedtime story about monsters. Moving to next title, Anthropic deal to help colleges teach coding. A cooler inflation print hit the tape, and the market still delivered its worst week since November. That's the moment. That's the signal, because it tells you something uncomfortable about how prices are being set right now. Not by a calm appraisal of cash flows, but by a narrative shockwave, fear about what AI might do to entire industries, moving faster than analysis can keep up. This is from the Wall Street Journal, and what I want to do is treat the week like a case study in capital allocation under stress. Not in the academic sense. In the real sense, the kind where even professional investors find themselves reacting first, rationalizing second, and only later admitting what really happened. They got pushed around by the emotional tempo of the market. If you're a value investor, you're supposed to love weeks like this. Not because you enjoy pain, because you understand what volatility really is. It's not risk, it's the market showing you its psychology, it's information about incentives. It's mispricings forming in real time because humans can't help being human. But only if you're disciplined enough to read it correctly. The central figure in this story isn't the Federal Reserve. And it isn't an AI founder. It's the allocator, the CIO, sitting in the chair where all narratives collide. The Wall Street Journal quotes Scott Ladner, Chief Investment Officer at Horizon Investments, saying the market is reacting in a way that suggests entire industries are going to be worth much less money than they are today. And he adds a line that matters because it reveals the gap between what's happening and what's true. He thinks that might be overblown, but investors are selling first and asking questions later. That's the cycle. A new technology appears. The mind extrapolates wildly. The market overshoots in both directions, first greed, then fear. And the hardest job in investing becomes staying honest about what you actually know. Now let's reconstruct the week the way the article does, because the sequence is the whole point. First, the inflation data. The Bureau of Labor Statistics reports consumer price growth slowed to an annual pace of 2.4% in January. Stocks initially rose. Investors saw a path where easing inflation plus robust labor data earlier in the week could let the Fed cut rates without an economic downturn. That's the soft landing script. Lower inflation, strong jobs, lower rates, higher multiples. Then the script breaks. Not because inflation reaccelerated, not because the labor market cracked, but because the market couldn't shake a different fear. The long-term disruptive potential of AI hitting multiple sectors, software, insurance, wealth management, legal data, even trucking, the article says. Read that list again. It's not one industry, it's an economy-wide threat narrative. And once a narrative becomes economy-wide, correlation rises. People stop discriminating. They sell baskets. They de-risk. They run toward whatever feels safe. So the day ends choppy, with reversals, and the week closes red. The Nasdaq falls 0.2% Friday and extends a 5-session loss to 2.1%. The article points out that makes it the Nasdaq's 5th consecutive weekly decline, its longest such streak since the 7-week slide ending in May 2000. The S&P 500 edges up by less than 0.1% Friday, but ends the week down 1.4%, the biggest weekly loss since Nov. 21, when anxieties over lofty tech valuations and aggressive AI spending plans drove a similar retreat. The Dow adds 0.1%, 49 points, mixed on the day, ugly on the week. Now here's where allocator behavior becomes visible. When investors get spooked, they don't just sell, They rotate, they express fear through where they hide. The article says investors sought out traditional havens, utilities, boring, regulated, sleepy utilities, rise 7.1% for the week and close at a record, the best performance among the S&P's 11 groups. And in rates, you see the same reflex. A rush into government debt pushes the 10-year Treasury yield down to 4.055%, its lowest since November 28th. So the market is doing two things at once. It's repricing perceived disruption risk downward across broad swaths of the equity market. And it's bidding up duration and defensives as if to say, I want cash flows that feel protected from technological chaos. But then the article gives you the part that separates reactive investors from opportunistic ones. It says the seemingly indiscriminate selling created entry points in stocks that were crushed by the broader retreat. Amazon is the symbol. The article says Amazon notched its 9th consecutive daily decline on Friday and has lost $474 billion in market cap. Over that streak, the longest since July 2006. 9 straight down days, $474 billion evaporated. That's not fundamentals. That's positioning and narrative and flows and, let's be honest, fear. Robert Edwards, CIO at Edwards Asset Management, puts words to the posture value investors are supposed to have. You've got rate cuts coming, prices coming off highs, everybody freaking out over tech and software. This is the wall of worry, and that's where opportunity comes in. That's the philosophy. But philosophy is cheap. The question is, can you actually behave that way when the tape is screaming at you? Now let's do the decision autopsy. I want to treat this week the way I'd treat a CEO's capital allocation choices during a downturn. What was expected, what happened, what you gave up, what you gained. Decision 1. Investors see 2.4% inflation and buy risk early in the session. What was expected? Confirmation that macro is improving and rates can come down. What actually happened? The market's attention shifted hard toward AI disruption fear, and the early optimism faded. Opportunity cost. Anyone who chased the initial bounce without a thesis got whipsawed. Hidden trade-off. In a narrative-driven market, macro good news can be trumped by structural fear, even when the data is supportive. Decision 2. Flight to havens. Utilities up 7.1% in a week. Treasuries bid yields down to 4.055%. What was expected? Safety, lower volatility, protection from the unknown. What actually happened? You concentrated into the same defensive trades everyone else ran toward, at prices that can get stretched quickly when fear is crowded. Opportunity cost. You may miss the rebound in high-quality businesses that are temporarily marked down because people sold baskets. Hidden trade-off. Defensiveness feels prudent, but it can become a form of performance chasing when it's motivated by panic instead of valuation. Decision 3. Selective opportunism. The article notes a bright spot even inside AI. Applied Materials up 8% after better-than-expected results, boosted by soaring demand for AI computing. What was expected by those holding it? That the picks and shovels layer of AI could keep printing cash even if the narrative whipsaws. What actually happened? A fundamental beat cut through the fear, at least for that name. Hidden trade-off. You still have to separate AI as a theme from this company's actual earnings power. And then the article briefly shows the risk-on reflex returning in other corners. Bitcoin up about 5% to 68,735, and Coinbase up 16%. That's not stability. That's the market's schizophrenia. Fear and greed are not opposites in real life. They're roommates. Now the visuals, because the on-screen evidence matters and you asked for explicit cues. On screen, you see a chart labeled Index Performance this past week, showing the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite, plotted in 10-minute intervals. The week looks like a jagged staircase down, frequent reversals, no clean trend line. Just a persistent grind lower that matches the article's description of choppy trading with frequent reversals. This visual is measuring something simple, price movement, but what it's really showing is indecision under stress. On screen, you also see a day performance panel with a sequence from Monday through Friday, sourced to FactSet. The exact numbers matter less than the pattern. Red days stacking, momentum feeding on itself, and then a late-week attempt to stabilize that doesn't erase the damage. This is what it looks like when investors de-risk broadly and then look around afterward for justification. Now the reality check, this is the uncomfortable part. The article says investors are afraid that AI has long-term disruptive potential across multiple industries. That could be true. Some business models will be impaired, some moats will shrink, some pricing power will evaporate. But markets don't price some. They often price all, especially in a week like this. They paint with a roller, and that's where mispricing comes from. Scott Ladner's quote, "Industries worth much less money," reveals how extreme the discounting impulse can get. In value investing terms, the market isn't just trimming growth assumptions, it's implicitly rewriting terminal values for broad sectors, and that's rarely done accurately in a single week. This is where perception lags. Reality, perception moves at tweet speed, while business models change at operating speed. The market can lose its mind long before a company loses its customers. 3 lessons, timeless and directly tied to what we just saw. Lesson 1. In a narrative shock, correlation rises and discrimination falls. When investors sell first, you get bargain candidates not because the business is broke, but because the market temporarily stopped pricing them individually. Lesson 2. The best entry points often come disguised as embarrassment. Amazon down 9 straight days and $474 billion in market cap loss is the kind of tape action that makes people feel foolish for even considering buying. That emotional hurdle is part of the opportunity. Lesson 3. Defensive positioning isn't the same thing as intelligent risk management. Utilities at a record after a 7.1% week can be safety, or it can be crowding. The difference is valuation and your time horizon, not the label on the sector. Now the ending, with conviction answering the core question this article raises. So what is this week really about? Is it about inflation? Is it about rate cuts? Is it about AI? It's about the market's tendency to overreact to the future when the future feels unknowable. And here's the sentence to remember for years. When the crowd sells first and asks questions later, your edge is the willingness to ask questions first and be patient enough to buy when the answers are still unpopular. Now, towards last article, the convenient story trap when perimenopause becomes a blindfold. 2 years, 11 doctors, and a symptom so relentless it turned sleep into a scarce resource. And the diagnosis wasn't what everyone kept telling her it was. It wasn't perimenopause. It wasn't hormones. It was cancer. Stage 2, Hodgkin's lymphoma. That's the fact that should stop you cold. Because it's not only a medical story, it's a decision-making story. It's a pattern recognition story. It's a story about how smart systems fail in the most predictable way possible, by grabbing the most convenient explanation and refusing to let go. This is from the Wall Street Journal, and I want to treat it the way I'd treat an investing mistake that looks obvious in hindsight. Not with blame, with incentives, with constraints, with a clear autopsy of how the process drifted into a wrong answer and stayed there while the clock kept compounding. Because time is always compounding. In markets, in business, in health. The opening image in this piece is visceral. The itch creeps up her back, across her stomach, along her arms and legs. It flares during morning runs, follows her to the office, and gets worse at night. She's covered in marks from scratching during the few short bursts of sleep she can steal. She looks and feels, in her words, like a mauled animal. That's not a mild symptom. That's a life takeover. Now, who is the central figure here? It's tempting to say it's the author, the woman suffering, the patient. And emotionally, yes, but operationally, the central figure is the diagnostic process, embodied by a chain of doctors, because the diagnostic process is the allocator. It decides where attention goes. It decides which tests get ordered. It decides which hypotheses get funded with time and money. And in this story, the process behaves like a lazy capital allocator. It keeps doubling down on the highest probability narrative instead of paying for the option value of being wrong. The doctor's role becomes a constraint, not because they're malicious, because they're human, living inside a system that rewards speed, pattern matching, and most likely answers, especially for middle-aged women whose symptoms are now being filtered through a cultural megaphone called menopause. And the patient, this is the part that hurts, becomes a reluctant operator. She's the CEO of her own case, but she doesn't know she's the CEO. She doesn't know what to demand. She doesn't know when to call for a deeper workup. She doesn't know how to force the system to widen the aperture. So what worked for a long time? The most likely approach, the heuristic. Middle-aged woman, itching, fatigue, weird symptoms, and the world is talking non-stop about perimenopause. It's a neat fit, it's socially validated, it's everywhere: Instagram feeds, celebrity stories, products, pills, creams, podcasts. The article says she assumed it was hormonal too. Doctors did as well. One doctor shrugs and says, "It's what happens to middle-aged women," explains that dropping estrogen can thin dry skin, and tells her to put lotion on before bed. Another doctor rules out allergies and says it must be perimenopause, puts her on birth control. She tries more. An intuitive wellness practitioner, trained in nutrition, botanical medicine, homeopathy, promises root cause, doesn't deliver. A functional health doctor prescribes progesterone cream. She spends thousands of dollars searching for solutions. She changes diet, cuts gluten and dairy, drinks celery juice, tries supplements labeled hormonal detox. And the itch continues. Here's what quietly stopped working. The initial story stopped being a hypothesis and became an identity. Once perimenopause becomes the label, every new symptom gets forced to fit the label. Even when the symptom is screaming that it doesn't belong, the inflection point arrives with a new weird pain while drinking alcohol. She believes a gastroenterologist who says it's acid reflux likely caused by hormonal shifts. She loads up on Tums, then quits drinking altogether. Then a more alarming symptom: stabbing chest pain during morning runs, struggling to breathe deeply. She thinks it's a Pilates injury. After a couple weeks, she sees a nurse practitioner. The nurse practitioner sends her to the emergency room for a CT scan to make sure it isn't serious. That decision, ordering the CT, was the pivot. That was the first time someone allocated capital to reality instead of narrative. And the CT scan reveals the kind of truth that makes you understand how fragile your assumptions always were. A 10-centimeter mass in her right lung and fluid building up in her lungs. 10 centimeters. That's not subtle. That's not a little off. That's a major, physical, undeniable fact that was growing while everyone was soothing it with explanations. She's sent by ambulance to NYU Langone Hospital. Doctors drain a liter of fluid from her lungs. She goes through a PET scan, a breathing test, a lung biopsy. The pulmonologist suggests she make an appointment with an oncologist specializing in lung cancer. And then the actual diagnosis lands: Stage 2 Hodgkin's lymphoma, a blood cancer. The article states that a common symptom is persistent itch. Now I want to do the decision autopsy the way a value investor would do it, cleanly, unsentimentally, but with deep respect for what's at stake. Decision 1. Repeatedly accepting the most likely diagnosis, perimenopause, as the primary explanation. What was expected? A benign, common, manageable cause. Symptom relief through standard interventions. What actually happened? 2 years of persistent symptoms, escalating disruption, and delayed identification of a serious underlying disease. Opportunity cost? Earlier imaging, earlier specialist escalation, earlier treatment, and 2 years of life spent in exhaustion and withdrawal. Hidden trade-off: the comfort of a socially acceptable label versus the discomfort of uncertainty and further testing. Decision 2. Spending money and effort on an expanding stack of interventions. Creams, pills, alternative practitioners, dietary changes. What was expected? A breakthrough, a root cause, relief. What actually happened? More sunk cost, more fatigue, and more reinforcement of the wrong frame. Because when you've invested so much in a story, you start needing the story to be true. Opportunity cost: resources and attention that could have been directed toward higher signal diagnostics when symptoms persisted. Hidden trade-off: you feel like you're doing something, but you're doing something inside the wrong model. Decision 3. The nurse practitioner's choice to send her to the ER for a CT scan. What was expected? Probably reassurance. Rule out serious causes. What actually happened? The first definitive evidence that forced the system to update. Opportunity cost: none. This is the option that should have been bought earlier. Hidden trade-off: it required someone to ignore appearances. You don't look like you are in distress, and still insist on checking. Now the visuals, because you said the viewer will see any photo or graphic included, and the narration has to align. On screen, you see an illustration of the author, Jessica Tonkel, rendered in a clean editorial style. It anchors the story as personal, not abstract. This is not a statistic, it's a person whose daily life was shrinking. On screen, you see a photograph of her, Jessica Tonkel, alongside the story. She's not presented as a patient in a hospital bed. She's presented as a functioning professional, which is exactly why this kind of miss happens. Suffering can be invisible, and competence can mask severity. And then, the most important visual in the story is one you don't see, but you have to picture. The CT scan result that shows a 10-centimeter mass and fluid in the lungs. Even if the image isn't printed, the narrative forces it into your head. A hidden reality made suddenly visible by one diagnostic decision. Now, the reality check. This piece is a warning about pattern recognition turning into a pattern prison. Doctors focused on the most likely answer and failed to dig deep enough to find the actual problem. She writes. And she didn't know how to ask them to probe further. The article explicitly calls out the pendulum swing. Medicine historically ignored women's distinctive symptoms, but now growing awareness of hormone fluctuations can create a new danger, writing off symptoms as hormonal when they indicate something more serious. One doctor quoted says, "We are oversimplifying health and reaching for simple labels to explain complicated things." This is exactly what happens in investing too. We take one explanatory variable, rates, AI, inflation, a new era, and we force everything into that one variable until we miss what's right in front of us. Perception lags reality because labels are sticky, and updating is emotionally expensive. Now the 3 lessons. Timeless and usable far beyond medicine. Lesson 1. The most dangerous stories are the ones that are plausible, popular, and convenient. They don't feel like mistakes while you're inside them. Lesson 2. Persistence is a data point. If a symptom, or a business problem, doesn't respond to the expected fix, the correct move is not to keep trying louder versions of the same solution. The correct move is to challenge the diagnosis. Lesson 3. Option value matters. A CT scan is expensive, yes, but the cost of not buying diagnostic certainty when the situation is persistent and escalating can be far higher. In capital allocation terms, you pay a small premium to avoid catastrophic downside. Now the ending, with conviction, answering the core question this article raises. How does a system that's supposed to help smart people arrive at the wrong answer for so long? It happens when incentives reward speed, when culture supplies an easy label, and when the person with the most at stake doesn't feel empowered to demand a deeper search. And here's the one sentence to remember for years. When the easy diagnosis doesn't fix the problem, you don't need more treatment, you need a better question. This is Avi. Like and subscribe. On to the next.